I'm super excited here to host the Forecastr team for the first in our Forecastr Fridays series, today being focused on financial modeling 101. And then after this, the next two Fridays are just going to build from here on how you can take the financial model and use it to make better business decisions and how you can use it to raise capital as well. The reason why I was so excited to be connected with Forecastr in the first place was because I'll tell you, at Startup Hype Man, my team and I, we have worked on hundreds of pitches. And the number one question that we get, aside from like, oh, like what should my message or what should my pitch be? The number one question we get is, how much do you think we should raise? Or the follow-on question to that, or the related question to that will be things like, does our CAC look right? What should our projections be? Those kinds of questions. And my answer, unfortunately, is always, I am not a financial modeling expert. I'll be like, so given that I'm not a financial modeling expert, I'll just give you my moron opinion. And I was like, this looks like it could work. It looks like it could not work, but please find an expert for this. So that's why bringing on Forecastr for this made so much sense. Their software is fantastic because it just helps you like build a financial model, essentially like automated. You don't have to, essentially go to a very expensive consultant to get that done. And I think what we're going to talk about today is going to be super valuable for every single person who's on this today. And if you're raising capital, if you plan to raise capital, even if you're not raising capital, but you're trying to make better business decisions, it starts with having the numbers figured out. The more you can make decisions based off of real projections, real numbers, a real understanding of what your business does and doesn't do, the easier it is to scale. So with that, I'm excited to turn it over to Logan to take this show away. Logan, I'll pop in if I've got a thought or a question or a comment, and I'll also be surveying the Q&A section. So actually real quick, before I give it over to you officially, as we go through this, if you have a question, please use it in the Q&A section of your Zoom box there. If you put it in the chat thread, we might see it, but it might get missed in the chat feed. So please reserve the questions that you have for the Q&A box specifically. And Logan, do you want me to like interrupt with questions, or do you want to reserve them for the end?
Whichever you all want. I'm totally cool with anything. I like keeping this kind of casual. So if you got a question that you think is pertinent, go ahead and throw it out while I'm in it.
All right.
Otherwise, we're going to have, like, it usually takes me about 45-ish, like 40 to 45 minutes to make it through the material. So we should have like 10, 15 minutes of Q&A at the end. So Perfect. Your call. I'm comfortable with it though.
All right, cool. We'll see. I'll determine based on what the question is, if it makes sense for in the moment or if it makes sense to reserve it for afterwards. Take it away.
All right. Well, thank you so much for that amazing introduction. So I'm going to go ahead and share my screen, and we're going to go ahead and get rocking here. So thanks everybody for joining me today and us today for Financial Modeling 101, aka the power of a great financial model. Now, as you might imagine, I talk about this a lot, and financial modeling is a subject that's very, very near and dear to my heart. I think that it's a very misunderstood subject. There's an intense lack of clarity around the subject of startup financial modeling. I used to be one of those expensive consultants, right? So I used to be the person that would charge thousands of dollars to build financial models in hacky spreadsheets. And I'll kind of like tell you the story of why financial modeling is so important to me operationally, was because whenever I first had the idea of Forecastr, me and my co-founder, Steven, both had the idea of Forecastr, we had to go out and we had to raise a pre-seed round of about $600,000. And we're based out of Louisville, Kentucky, which is a really, really tough market to raise in for those of you all that aren't familiar with it. And we had essentially no traction, no revenue. We didn't have a product. We didn't have anything. All we really had was ourselves and our experience. And we had built a really, really great financial model to help us go out and pitch investors. So the best way that we could de-risk the investment for the investors was by showing them a good financial plan, because we had no other levers, right? We didn't have revenue, we didn't have products, we didn't have anything like that. And so we leaned hard on that model, and we continue to lean hard on that model. And even back then, at the very early inception of the company, we were able to eventually oversubscribe that round. So we ended up raising 750 instead of the 600 that we went out to raise. And I attribute a lot of that success to the financial model, and us leaning really, really hard on that financial model as a storytelling device. So a lot of what we're going to be going over today is going to be setting you up to have some of that same level of success. And we're going to talk about some of the other key aspects of a financial model and what makes it so great. So it's going to be an exciting topic. I'm going to try to keep it as entertaining as possible because I know it can be somewhat dry to some folks. So we'll try to keep it fresh. Before I dig too deep into the content, I do want to give you a really quick introduction on myself. So I'm Logan Burchett. I'm co-founder, chief operating officer over here at Forecastr. And I'd say I've been a finance nerd pretty much my entire life, but definitely within the past, 10 years or so that I've been in the workforce. So I started off working at the Kentucky Pension Fund. I managed their entire stock portfolio. And then I ended up leaving. I became a fractional CFO for dozens of venture-backed startups, helped them raise millions of dollars. And that's where I really honed my financial modeling craft. That's eventually what led me to starting Forecastr and meeting my co-founder, Steven, who you can see on the slide next to me. And, now Forecastr, we've been going at it for a little while now, got about 1.4 million in revenue, raised about $5 million. So, and actually wish us luck because we're getting ready to kick off a Series A here in the next couple of days. So we built a lot of financial models. Now that we've started Forecastr, our team's built, thousands of financial models. And I'm also a finance mentor at Gus, Techstars, New Chip, GSV. So know the finance game better than most folks you're likely to meet. And I don't want to turn this into a sales presentation, so don't want to get too deep into that, but I do want to get you all a sense of what Forecastr is. So Forecastr is essentially an online software that helps founders build great financial models so that they can understand their numbers, make better decisions, and get funded. So really the heart of what we're doing at Forecastr is honestly, we're just trying to make forecasting and financial modeling more accessible and understandable for everybody. It used to be that larger middle market companies or publicly traded companies, they'd have entire teams, they'd have finance departments that would go in and glean insights and spend a lot of time structuring formulas and all of this stuff. And it was way too complex for earlier stage startups to see the same level of benefit. So what we're doing with Forecastr is we are essentially boiling down a lot of those insights, a lot of the time and money that's spent, in these bigger companies that are trying to understand this stuff. And we're really servicing a lot of that same value for earlier companies. Now, historically, all of this has been done in Excel. Now, we are Excel experts over here at Forecastr, but our opinion is that Excel is not something that should be leaned on too hard whenever it comes to FP&A. And the reason for that is it's clunky, it's hard to learn, and it's unstandardized. That means that every model is different than every other model that was built, which makes it really, really hard, if not impossible, to automate anything. You can't link up your data sources. You can't compare yourself to cohorts or anything of the sort. So Forecastr, every model is still unique, but it is standardized on our platform. So you can do all of those great things. And we also have a team of experts that are going to help you along the way. I always like to say that that's our best feature over here at Forecastr is our team. So they're going to be with you from the initial build on through any questions that you may have. So if anybody here is interested in Forecastr, Calvin, who's on here from my team, if you want to drop a link in the chat to apply, then you're more than welcome to do that. So I want to set the stage here with a quick agenda. So we're going to be talking about the why of financial modeling. So why do we bother, right? Why does this matter? Why am I even talking about this? Why does anybody care about financial modeling? Then we're going to go through what an investor grade financial model looks like, and we're going to run some tests on that. We're going to discuss very briefly how to build one and then how to use it effectively once it's built. But I like starting at the very, very baseline and starting very, 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 from the start and saying, what is a financial model, right? I've been talking about financial modeling for a long time since starting Forecastr. And what I've noticed is if you ask 100 different people this question, you're going to see 100 plus different answers. So there's a lot of different variations on what a financial model can do. And I'll say here, if anybody's brave enough, I'd love to see if anybody wants to give me their definition of a financial model. And Calvin, I'm not sure how easy it is for people to actually come off mute here, but if anybody wants to, and if it's easy, I'd love to hear anybody's definition of a financial model. Or if you want to put it in chat, that also works.
Yeah, I think maybe doing the chat will be easier because I think otherwise they'll have to in the webinar format, they don't have the ability to bring themselves off of mute.
Right. Okay.
Yeah, cool. I was looking and they can't raise their hand here. So yep, chat will be best.
That works. Okay, cool.
So we got Shubha saying a financial representation of how a business works.
Yeah, I like that. It's so that to me shows kind of the communication aspect of financial modeling, right? Like you can show how a business is working and you can use it using the lens of finance rather than perhaps a pitch deck or something like that, or perhaps adjacent to that. Program Pool tool where you can set and change variables and it automatically shows you forecasts to help you answer questions. So yeah, I really like that one. That one's more tilted towards the operational side of finance, right? Like I can get the levers and I can tweak certain things and I can see what the downstream impacts are. So DJ, I think that's a really good one. And then yeah, I followed up with that way to forecast revenue, expenses, cash in the bank, all of that good stuff. Levers drive the business. Great.
Simulation of a business's future financial information. Ron is saying shows the levers at the business's disposal and how they affect the business. Which one do you like best? I'm curious. Out of all, like I read all of these, and as a non-financial expert, I thought DJ's second one on way to forecast revenue, expenses, cash in the bank made the most sense to me. What do you think?
Yeah. So there's one person in the audience that's cheating, and that's Michael Ford from our team. So that one's got favorite. So I'm gonna but that is my favorite of these. So I'm gonna flip back and I'll kind of show you why. So the reason that I like that one so much that Michael threw out was because, we really believe that holistically a financial model can essentially simulate your entire business. Now, kind of like use an analogy to explain why this is. This is an analogy I did not come up with. I actually stole this from a guy named Troy Hinikoff. He was the MD of Techstars Chicago, really sharp guy and a mentor of ours. But he came up with this analogy that likens financial modeling to the early days of the car manufacturing process. So if you're following the slides here, you can really see what like the design phase of the car manufacturing process used to look like. And I always say on every webinar, I don't know when these pictures are taken. This looks like, I don't know, like the 40s, 50s, maybe 60s. I don't know. But either way, before computers were a thing, the design phase looked a lot like this. So you would like take a piece of paper, right? You would sketch out what you think the car is going to look like down to the component level, make sure the measurements are right, everything's good. Then you take this giant slab of clay and then you all the way again down to the component level to scale everything. You build everything out. So you can see this guy here on the right. He's essentially doing that. He's trying to get a scale mock-up of this car. Once you get that and you get a sense of kind of like how things work together, then it's straight to the assembly of the working machine. So now you've got to actually put the parts together, create a running vehicle, right? And then once you have something that actually runs, that's actually workable, then you have to get somebody to go in and test this car, right? This is a car that nobody in the history of the world has ever driven a car quite like this. If you're doing any kind of innovation at all, there's a lot of risk there. And then you've got to get in and you've just got to drive it to see if the car performs well enough to go to mass production. So they'd run a series of tests. They would send it on a track, and like one of them might be the 90-degree turn test, right? If you take like a sharp hairpin turn, what does the car do, right? Sometimes it'd be fine. The car would perform well. But then sometimes, because it's a new concept and nobody knows what's going to happen, the car will flip over, right? It'll tip over. And then you've got to figure out, okay, now, A, we got to pay the hospital bills of whoever it was that was driving that car, or whatever, if they're hurt. But B, like, where was the point of failure? What caused this? Now we got to go all the way back to point A. We got to retry and retry and retry. Then we got to build a new one. Then we got to sculpt a new thing out of clay, and so on and so forth, until eventually you get a car that doesn't flip over whenever it does that tight 90-degree turn, and then it's off to mass production, right? I don't think I need to explain to anybody why that's inefficient. That's a crazy thing. I mean, you're spending literally months and months and months. In this case, you're literally risking lives while doing this because somebody's got to drive the car, right? Which is not safe, right? So you're risking lives, you're spending months and months, you're spending millions and millions of dollars, and you're doing all this without even a guarantee that you're ever going to come up with a workable car, right? I mean, that prototype just could have been flawed from the ground up. So not the way that it's done by today's standards. So thank God for technology, right? Computers have come around. They've essentially overhauled this entire process. And somebody always points out to me, by the way, on every time I give this webinar, somebody points out, well, Logan, they still do physical testing. You still got to test the first. Yeah, fair enough. But nowadays, you always do software testing before you actually go in and build a prototype of a car that you can then go in and test on the track. So now cars can be designed and tested in minutes instead of months because we have a CAD system, right? I can go online, I can use software down to the component level, all the way down to the screw. I can simulate what that car is going to look like. It's going to take into account the weight distribution and everything. And I can build the entire car using the software. I can even put that car on a virtual track that's going to simulate real time all the different weather conditions, and it can simulate what's going to happen whenever it takes that sharp 90-degree turn. And it's going to be like 99 point whatever % accurate, right? So that way, not only will it be able to give me all of that accuracy, but whenever it takes that hairpin turn and then it flips over, it'll even be able to zoom in and tell me where the point of failure was. Like, oh, maybe it was this screw that like broke or something. I don't know anything about cars, but basically it can zoom in and say, this is the part that you messed up. This is the part that needs fixed. Would you like to fix this? Then rerun the simulation. Okay, cool. Click, click, done. And then you get to a point where you've got a car that you know can check the boxes and is safe to start doing some physical prototyping. And we think that this is the perfect analogy for a financial model, because in the same exact way, if you build a financial model, you can use technology to simulate your business, and you can run tests in months instead of years. So you can see what happens if you try adding a new product line, or you try a new marketing channel, or you invest in a sales force, or if you're really, really early, let's say, you can see if your business model is going to work, or if you need to completely switch it up, right? Maybe you're going to try a freemium model and that's not going to work for you because the market size isn't too big. But what you're doing essentially is you're seeing, can your business handle a sharp 90-degree turn? Like, is it going to be okay? And is it off the mass production, or is it going to flip over into a barrel roll? But just in the same way that we just saw with the cars, if there's an issue, it's fine. Nobody gets hurt. You don't get hurt. Your investors don't get hurt. Your co-founders don't get hurt. And it gives you a chance to really optimize and identify the points of failure and know where to focus before you jump in head first and you waste a lot of time and energy and money. So because of this, once you get it right, if you can build it right, then a financial model can be one of the most powerful tools in your arsenal, because it can literally simulate everything that you do before you do it. So that's kind of the high level analogy. That's kind of the high level value proposition of a financial model, is that it is a simulation. Once the simulation is built, there's any number of things that you can ask that simulation, and that's what makes it so powerful. But if I boil it down a little bit closer to home and we start talking more practically, what specifically are the things that a financial model is going to help me with? Well, a million, but if you dial it down into two separate buckets, you can kind of bifurcate it and say that generally a financial model is going to help you impress investors, and it's going to help you make better decisions and run your business better. Those are the two ways that we like to think about it. So I'll kind of talk about each of those. So the first one is it's going to help you impress investors, right? At the end of the day, like I said, it's a simulation of your business. It's essentially a mathematical representation of your business, and it's communicating through the lens of finance. So any of us that have ever fundraised before know that investors are financy people, right? If you go on LinkedIn of any VC, any big VC, you're going to see some finance background in there, I bet you, or at least some like financial tilted operations background. So they think in terms of metrics. They think in terms of finance. So to use another analogy, we're about to go raise our Series A. We're kicking that off next week. Let's say that I went to go pitch a big VC in France, right? Let's say I wanted to go pitch a VC in France, and everybody there spoke French. Ideally, I would go there and I would be able to pitch my business in French, right? I would be able to talk to them using their native language, because that's what they speak. That shows them that I'm one of you, right? Like, I can speak your language. I know what's going on here. Makes you a little bit more comfortable, and it shows that I belong in the room, right? In the same way, investors speak the language of finance. Really, that's what they're comfortable with. That's how they think. That's how they make their decisions. So if you can come to them and show them, I speak this language, right? I can communicate with you using your native tongue. I know what an income statement is. I know what CAC to LTV should be. I know what unit economics are. I know all of that. Then it's kind of like hey, this person belongs in the room. Like, they belong in the club. They get it, right? And now that I know that person's in the room, we can look at what they put together using that lens in the finance realm. We can look at it from a financial perspective and analyze it together. So it's a communication tool, and it's a nod to the fact that, hey, you belong in the room, you know what you're talking about. And it gives them all of the metrics they're looking for.
Can I jump in on this point for a second, Logan?
Yeah, absolutely.
So I can't like underscore this enough to everyone who's watching this, because you can have like a really strong pitch, right? Like maybe you've used a K-Pasa pitch, right, from our stuff from the Startup Hype Man. The challenge is if you've got a really strong pitch, and then there's a follow-up question like, what's your customer LTV, right? What are your 3-year projections? What's your acquisition cost? And you are like, the entire thing will fall apart because it's like, it doesn't matter if you've got good value at that, if you've got a good value proposition at that point, it means you don't understand your own business. And if someone's going to put potentially millions of dollars or hundreds of thousands of dollars into what you're doing, they are only going to do that if they feel you know how to handle their money.
Yep. That's a very, very good point. I'll say one thing that I like to say is that there's no better way to de-risk an investment for an investor than to show them a financial plan of how you're going to spend their money and turn it into more money. If I can literally show you dollar for dollar, you give me this money, this is how I turn it into more money, and you understand it, then that's the best way to de-risk it. And to your point, so like sometimes an investor will ask you a deep in the weeds question like that because they actually care what the answer is. But a lot of times they only ask it to see if you're on top of your stuff, right? To say, do you even know the answer to this, right? I'm throwing, I'm kind of like testing you out a little bit to see, are you the type of person that's going to be able to answer these tough questions? Because at the end of the day, if I'm an investor, I hope that one day you're going to get acquired, right? Or you're going to IPO. You're going to have to answer all of this stuff when that day comes. So if you can't answer it right now, then why should I bet that you know the answer then? So it's a good vetting tool, and it is very, very important to be buttoned up on that front. So that's the impress investors piece. The second piece, though, and I think I would argue that this is the more important piece, although they're both important, is that it's going to help you make better decisions. So I'm actually going to focus a lot of this, and actually show you instead of telling you how it can help you make better decisions kind of later on. But just kind of like keep this in the back of your head that it's a simulation. Once the simulation's built, you can ask it any number of questions. Should I hire this person? What happens if churn goes down? What happens if churn goes up? What happens if conversion rates fluctuate? All of that stuff. So I'm going to dig into that a little bit more a little bit later on in the presentation. But those are the two key value propositions: help you raise money, help you run your business better. So now I want to get into, all right, so we've talked about a financial model, right? We've talked about the high level value. We talked about a little bit more of the tangible value, specifically of what it's going to help you do. Now I want to get into the output of a financial model. So like, what does a financial model ultimately produce? And the way that we like to talk about it is that you have the financial model, which is like an engine that it's like you can ask it questions, simulation type of engine. And then you have financial projections, which is the output of a financial model. So one model can make an infinite amount of financial projections, right? You can think of projections as almost like a scenario. Here's my base case projections, best case projections, worst case projections. This is the projections if I raise 5 million versus 2 million and what have you. So you've got the model, which is the engine. Then you have the projections, which is really the output of the financial model. Now, in terms of the ultimate output of a financial model, for any of those that, do accounting or have QuickBooks or Xero or anything like that, we know that whenever we report to investors or whenever we talk to our accountants or anything like that, we get financials in the form of these three statements, the big three financial statements: the income statement, the balance sheet, and the statement of cash flows. This is how we historically analyze finance. And because this is how accounting works and how the world has decided that we're going to be analyzing finance historically, we match that and we do that exact same thing when we forecast. We do it on a forward-looking basis. So it's very clean whenever done right. I can look at, this is what has happened in the past. I can map that directly to what's going to happen in the future. And you can kind of see that trajectory right there. So you can kind of like see what's realistic, right? I don't want to go too deep into what each of these mean, just because I could spend probably an entire webinar on any of these, individual statements. So I'll keep it high level, but I will just like quickly talk about what the purpose of each of them are. So income statement, I think, is the one probably most of us are the most familiar with. And that's really going to be the statement where we report on things like revenue and expenses. That's what's going to show us our net income. Essentially, it's the statement that's trying to answer like, how much revenue are we making and are we profitable, right? And what are our margins? So you're going to see revenue, expenses, then you're going to see net income on there. Because it houses revenue and because it gives you good data on how much cash you're burning or how much profit you have, that's usually the statement that everybody zooms into first, including investors, right? The income statement's usually the biggest one that people want to talk about. But then you have these other two, which are equally as important. So the balance sheet is going to tell you essentially what you everything that you own or owe, right? Everything the company owns or owes. So the way that I think is the easiest way to understand what a balance sheet is if you personally try to write down what your net worth is, and you have to you almost look at it as like a things that I own and then things that I owe other people. And then you can kind of net out what your own personal net worth is. That's kind of like what a balance sheet is. So if I'm looking at my personal net worth, I'm like, okay, I've got so much cash in the bank. I've got a house. Okay, so I own that, but then I've got a mortgage over here. So I owe that. So you can net that against each other. And you can kind of get a sense of, well, I've got a car, that's an asset, but I have a payment. So that's a liability. And then you can kind of net those two out. And then it's going to give you your net worth. And that's going to essentially be the balancing of the equation, which in this case would be equity. So it's kind of the net worth of a company. Let's say it's how much, what do you own versus what do you owe is what's reported on the balance sheet. And then the statement of cash flows is really just a statement that sits in between those two. And the entire purpose of that is just to show what's happening to cash, right? What does the cash flow of the company look like from a month to month, week to week, year to year basis? Where is cash going, and segmenting out in different ways? So those are the big three financial statements. Happy to dig in if anybody has questions toward the end and wants to get deep into those. But for now, we'll just leave it high level and kind of move forward. So because there's so much going on in a financial model, you got three separate financial statements. You have a lot of metrics that kind of boil up to those three financial statements. We get asked a lot, where should I focus my time, right? If I'm going to build a financial model and if I'm going to spend time putting this together, because it is a decent amount of work if you're going to build it from scratch, what do I need to focus on? Where do I need to spend the majority of my time to make sure that I'm hitting home with the right people? It's a very easy question to answer. So by far, most important thing that you need to do whenever you're looking at forecasting is forecasting your revenue, right? Why is that? Well, is because that's the thing investors care about the most, right? Is your revenue. It's the hardest thing to predict. It's the most difficult thing to control. And it's the reason that most businesses end up failing is they don't end up generating a lot of revenue, right? Or they don't end up hitting their revenue targets, right? Trust me, there are plenty of companies that fail to generate a lot of revenue, but the thought being that if you're beating your targets and generating sufficient revenue, you're probably going to be able to get some money in the door and get investment and stuff like that. So because of that, we think revenue is definitely the most important to focus on. And because it's really important, it's really important. There's a concept that I'm going to talk about called the revenue formula that's really important. And what the revenue formula is essentially a mathematical representation for how you're going to be getting revenue, right? Like all the way down to the metric level. What are the different things that are going to ultimately add up and culminate to my revenue, right? So we're going to dig into a revenue formula right now for a sample business, just so you fully understand this concept. So this is for a subscription business model. I recognize that not everybody in here has a subscription business model, but this is the most common business model out there for SaaS companies, or really for technology companies, let's say. So I wanted to focus on this one just because I think it's relatively easy to understand, but you would have to do this kind of regardless of what type of business that you run. So this is for a subscription business model. Before I dig too far into this, I want to call out that, first of all, it's kind of obvious, but it's a tree-like structure. So you should look at it kind of from the top down. So every metric, what we're trying to do is dig into the metric that ultimately rolls up into creating that metric. So you can see as you go down, it's kind of rolling up ultimately into what is calculating revenue. Now, you'll note I've got a little key here down at the bottom, but we've got two different types of metrics, as we call them. We have input metrics, and then we have just like really formula metrics, right? The green metrics are, you can think of as like formulas. Now, an input metric is something that I can control on some level, right? It's worth noting that not all inputs are created equal. So some inputs I have direct control over. And like I'm looking at price for this one, I could go into Stripe right now and change the price of Forecastr if I wanted to. Right? There'd be all kinds of downstream impacts of that if I did that, but like I could do it, right? I have a direct control over that metric. And then there are other metrics that I don't have direct control over, but I can influence, if I really focus on it. My conversion rate, for example, I can't click a button and then double my conversion rates, but I could adjust the copy of my website. I could run a bunch of A/B tests, and I could, do some other things to really enhance that conversion rate. So in general, the goal of the revenue formula is to start at the highest level and then keep going deeper and deeper and deeper into how you calculate everything until everything is a purple input. Everything is a something that you can control, so that ultimately it should give you your knobs, right? Like if you're thinking of it in terms of like, if I twist this knob, what happens to revenue? This is how you get to understand what are all of the knobs that I can twist to ultimately run up and influence revenue. So in this case, I'm going to walk you through this kind of step by step. So if we start at the highest level, we've got revenue equals price times subscribers, right? That's easy enough, right? I have a number of people paying me something. I have a dollar amount that they're paying me per month. I put those together. That's revenue. I'll note that a lot of financial models will stop there and they'll grow that subscribers by X% over time, right? But that's not helpful. The more important thing to do is to dig in to find those levers and those knobs to figure out how you're actually going to be increasing revenue. So I'm going to go a little bit deeper. So my price, there's nothing to do with. Like I said, it's already a purple input. I can already change that, pretty easily. But my subscribers is not quite that simple, right? There's a lot that goes into calculating my subscribers. So let's go one layer deeper on that. We can see that my subscribers at any given time, generally, is the subscribers I had last month, plus any new subscribers that I got this month, minus any subscribers that left me, essentially, right? So I had some amount last month, some came, some went, and now I've got a new amount. That's the idea, right? So now we can further dig into the number of subscribers. We can kind of look at each of those and say, all right, let's look at the subscribers that we lost. Well, if I go a layer deeper, that's calculated by taking however many subscribers I had last month times the percentage that churned, or AKA my churn rate, right? For those of y'all that are a SaaS business, everybody's, should be fairly familiar with churn. It's essentially the percentage of customers that leave me in a given time period. So in this case, we're looking at it monthly, the percentage of subscribers that left last month. So that's something that is a purple input because I can influence, I can run campaigns to try to reduce that churn rate. If I'm looking at how I'm getting new subscribers, there's a bunch of different ways that you can get those, and you can see those in my revenue formula. So in this case, we're saying I can get new subscribers from Google, from email, and new subscribers from Facebook as well. So ideally, you'd want to dig into each of those specifically, but in this case, I'm just going to look at Google just to keep things a little bit more simple. So this assumes that this is a paid traffic source, right? So I'm paying for Google, and in this case, it's going to be our traffic from Google multiplied by our conversion rate. Okay, conversion rate's that purple input because there's nothing I can influence it. I have some sort of influence over that. And then how much traffic I get is a formula in this case because it's paid. So it's my monthly budget divided by my cost per click. And both of those I can control. I can spend more money on a budget, and then my cost per click I can go find. It's kind of given to me, right? Like there's really nothing I can do for that, or I could go find cheaper keywords. So if I wanted to influence my traffic from Google, therefore our new subscribers, therefore our total subscribers, and then therefore our revenue, I could either spend money on paid ads, I could spend more on paid ads, or I could find a cheaper keyword, which would reduce our cost per click, or I could try to increase our conversion rate somehow through like optimization. And then I could also increase revenue over time by reducing churn too, because lower churn would decrease the total amount of subscribers that leave over time, and that's going to increase the total number of subscribers, and that's going to increase revenue. So if you take a few steps back, I think you can start to kind of get a sense of the real power of the revenue formula once it's built, because there's only 5 purple inputs on this slide, which means that there's only 5 things that we have some form of control over, direct or indirect, that can ultimately impact revenue. I could change my price. I could, try to reduce my churn rate. I could try to increase my conversion rate. I could spend more on paid ads, or I could try to find cheaper keywords. So it's our job as the owners of the business would be to find which of those levers has the highest impact on revenue and which one we can control the easiest, And then you want to optimize those over time until ultimately you're generating the maximum potential amount of revenue. So I'm going to take this away from theory a little bit. I'm going to put us into practice now. So I'm going to give us 30 seconds really quick for y'all to read the prompt on the slide, just to get a little bit of context on this business. And then I'm going to jump in and do an example to show you how we can use a financial model to get a business really humming. So 30 seconds on the clock right there, and then I will be quiet. All right, we are at 30 seconds. So hopefully everybody had time to read the prompt. So what we're going to do now, or I'm going to go to this if I can move things away. Here we are. Okay, cool. So we are in Forecastr now. So we're going to use a financial model and we're going to try to make some business decisions here. So Calvin, I'm going to give you a heads up. We're going to do the poll. If you know how to do that, I'm going to ask some questions. We're going to poll the audience for something. So just to give you all a little bit of context for what's going on here, based off the prompt, we have a couple of different ways that we're attracting customers. So you can see how I'm acquiring customers, and then you can see how those customers are turning into revenue. And then I've got 3 different ways that I'm generating revenue. I have subscriptions, I have advertising, and then I have add-on purchases. And subscriptions is kind of dominating here. So you can think of this as kind of like my baseline, right? I charge $29.99 for a subscription. I have a churn rate of 4% per month. So if you assume that we just keep growing in the way that we expect to grow, if I look at my financial statements, I'm going to go to my statement of cash flows. I'm going to zoom all the way out, and I can see that we're expecting that at the end of the model, after 72 months, we're going to have $8.74 million of cash in the bank, right? So that is to say, if I just keep going in the way that I'm going in 72 months, I should have almost $9 million in the bank, 8.7, and such, right? So I want to run a quick exercise, right? What I want to do is I want to see if I go into my subscriptions and I look at one of my inputs in my revenue formula, which is my price. If I were to double that, so it's 30 right now, let's say that I double it to 60, what is going to happen to my cash? So it's going to go up for sure because I've essentially doubled how much I'm selling my software for, or my subscriptions for. But how much is it going to go up? Is it going to go up by double as well, or more than double, or less than double? So Calvin, if you can put that in a poll, is cash going to go up by more than double, or less than double? We'll see what the audience thinks.
Cool. I'm almost done with it here.
Almost done. All right. And then I'm going to have one more poll for you after that, just FYI. So.
Cool. Less than double.
Okay, so we got the poll up. So if everybody wants to vote really quick, and just in case y'all wondering, yeah, it's if I double my monthly price, will cash more than double, less than double, or double? All right, it's a close one here.
Oh, looks like it switched up.
Well, it's still pretty. I'll give it like another just few seconds.
I feel like we're watching a horse race.
I know. Yeah. Well, what's funny is, so the audience can't actually see it until I hit in. So I'm going to hit in poll now so you guys can see. So it looks like the majority of people said it was going to less than double. So if I double my price, it's going to less than double. 37% said more than double, and then 11% said double. It's a tricky question, but I'm gonna reveal it. So if I go back to my statement of cash flows, remember it was 8.72, I believe, right? That was the number before. It was 8.72. I'm going to zoom all the way out. It is almost tripled, right? 24.54. So it is almost tripled. It is significantly higher than it had been. Now, the reason for that is because they're not just paying me double for 1 month. They're paying me double for every single month that the subscriber stays around, right? Because my churn rate is 4%. So they're staying for multiple months, if not years. So that's what's happening here. It's actually closer to 2 years that they're staying with me on average. So I'm always getting double that amount. So it culminates to almost triple the amount of cash. So that's obviously a really important metric for my business. If I can double it, then I can triple the amount of cash. So it's like if I double one, then it has a very, very high impact on the other thing. But here's the thing. If I were to just double my price, my monthly price, other things are going to happen, right? This is looking at it in isolation. This is saying if I double my price and everything else is equal, what happens to my cash? But that's probably not going to happen because all else equal, people don't like sticking around paying for things that cost twice as much, right? So what likely would happen is my churn rate would increase. So I'm going to do a new poll now. I'm going to say I've doubled my price. I've doubled my churn rate. Now what? Am I better off or worse off, right? So Calvin, I guess the question would be, if I double price and churn rate, am I better off than I was before, worse off than I was before, or am I back to the same? Does it cancel out in my neutral? So let's get that poll. Right. And that's the last poll, I promise. I just got two.
No, you're good. I'm cruising through here. And you said the third option was neutral?
Neutral, yep.
Cool. All right, you should be firing off.
Alrighty. Let's see what we got.
Oh, looks like it wasn't titled.
Okay, there we go.
Cool.
So everybody cast your votes. Let's see what we got. Okay. So we're getting people piling in here. This is a close one.
It doesn't allow me to vote. I'm gonna say you're worst off though.
Worse off? Okay.
Worse off, yeah.
Worse off?
Mainly because
yeah, go ahead.
The churn rate's got to be at a certain like multiple to still be attractive and for you to run your business. So if it starts to greatly increase, even if your price is doubled, if you're losing customers at a higher rate, it doesn't. I think it just it's like a net loss.
Yep. Well, we'll see what the math says. So it looks like a lot of people agree with you. So worse off is the number one voted for. So 47% said worse off, 32% said better, and then 21% said neutral. Okay. So luckily we have a good financial model, so we can actually answer this question rather than kind of like, guess. So, and I'll share the results, I assume. Yep, there we go. So now I'm going to go to my statement of cash flows and we're going to see. So remember, my original scenario said 8.72 million. So I'm going to scroll all the way to the right and we are still over double that or almost double that, right? So even though I've doubled my churn rate, because I've doubled my price, then my cash is still better off, right? So that means that my price or my business is significantly almost double more sensitive to price than it is to churn rate. So if I'm the CEO of this business, I'm going to do everything that I can to try to increase the amount of money that those customers are paying me, even at the detriment of churn. Because in my business, in my model, because I know my model, I know that that's going to be better off for me, right? That's going to make my business that's really going to be the best way to scale my business. And because I've done this, I can even show you that even if I make my churn 12%, right? If I triple my churn rate and then I go and I check it, then it's still going to be better off. I'm still $12 million or almost $13 million. And I was 8.72 or whatever before. So significantly more impactful would be increasing my price, even if it means having a higher churn rate. So I call this out. And the reason that I get audience participation here is because I want to show that these are hard questions. And if an investor asked you that question, what's more important, price or churn? About half of you would have answered wrong, right? Like, you know what I mean? Like you wouldn't actually know, but I can actually, now that I've done this, if an investor asks me that, I can say, yeah, actually, our model is about 4 times more sensitive to price than it is to churn, because I know that my break-even point for churn is 16%. If I put in 16%, then I get to about where I was before. Then I can answer that, and I can walk you through that entire thing, right? I can pull up my model. We can go through this together, and I can explain it to you. Do you think that's going to inspire confidence if you're an investor? I bet it would. If I know that off the top of my head, yeah, it's 4 times more sensitive. I've done this. That's a lot of confidence that's going to inspire. So that's why this is important. And not only is it important from the investor standpoint, now I can run my business better, right? I should spend more time trying to enhance the value of my customers and get them to pay me more, and maybe divert a little bit of focus from decreasing our churn rate, because I know that this part of the business is more important. So that's go ahead. You say something?
My takeaway from this is that everyone who's on this webinar right now who has already worked with Startup Hype Man, you're good. Everyone who has not, we're tripling our prices tomorrow. So sorry.
There you go. Yeah, it's good insight. Good insight. All right. I know that we're bumping up on time, so I'm going to come back in here and I'm just going to run through this one really quick. Talk very, very briefly about how to build a financial model, very briefly, because this is beyond one webinar. This is an entire MBA course right here. So generally, I would say if you could do any of these things, start at that top level, and ignore the bottom 2 if you can only do one thing, but ideally you would do all of this. So step 1, got to do that revenue formula. You just saw why that's important, right? I think that we can all agree that that's some important insights that you can get out of just that revenue formula. So try to get it all the way down to the component level for your company. And in doing so, you're going to need to forecast how you're going to be getting new customers, and you're going to want to forecast your revenue streams. Once you're done with that, now you're going to move into the expenses and the balance sheet items. So you're going to look at cost of goods sold, which are the expenses that vary with revenue, and then your hiring plan and all of your other operating expenses. Then you're going to go to the balance sheet, assets, liabilities, and equity. And then at the end, you're going to be putting all of your statements together, your income statement, balance sheet statement, and cash flows. Now, we do have some great templates if anybody's interested at Forecastr. So Calvin, if you want to share those, forecastr.co/templates, then we have templates that are already made, or you could become a customer of Forecastr and we'll do all this for you and we'll teach you how to use it. So we want to offer everybody on the webinar 25% off the first year of your annual subscription. Price varies depending on how much your monthly expenses are, but I'll say that generally most people would end up paying around $2,000 a year. Discounted would be $1,500 a year. If you have less than $100,000 of monthly expenses, that's what you'll pay. So it's very, very affordable. Covers your white glove onboarding, covers your 30 days with an analyst, and then all of the support you'll ever need for really the entirety of the subscription. So we'll drop if you haven't, I don't know if you've already dropped the link, but Calvin, if you want to drop another link, then there you go. And with that, I will open it up. We got like 9 minutes for questions. So I will open it up for questions.
Cool. We had a bunch of questions throughout this session. So I'm going to go in the order that I saw them come in. We're going to go back to Chris Geisler asked, can you talk about how, quote, accurate a financial model needs to be? For example, some Y Combinator advisors downplay financial models and pro forma because, of course, they can be developed to be overly optimistic.
Big time. Yes. So that is a very great point. Whenever I walk through a financial model with an investor, a lot of times to disarm them, the line I'll use is I'll say, yeah, the first thing I want to tell you about this financial model is that it's wrong, right? There's a 100% chance that I missed this forecast, right? Either high or low, I don't know. But what I can tell you is that this is my best guess, given the information that I have, of what I realistically think that this company is going to do over the next 18, 24 months, all the way out to the 5-year forecast. I will say savvy investors, if you're a good investor, generally, you're going to be significantly more interested in the logic behind the financial model and understanding the methods that you're going to be using to get customers and convert them into cash and how that works mathematically, than you are going to be in seeing what the 5-year number is, 5-year revenue number, 5-year net income number, and things like that. I will say that as something of a finance expert, the thing that I care about with a financial model is that the unit economics will scale if I don't change anything, at a certain point. If I can understand what the unit economics are today with maybe some level of optimization, if I scale, that can turn into a big opportunity, right? So that's really what they're interested in, is just making sure that you have a good handle on your economics. that it can scale to a certain extent. And I wouldn't, in terms of just taking the projections, the 5-year projections for what they are and saying that's going to happen, I think that's, anybody in the world can discount that, and I wouldn't blame them. So yeah, that's typically my response to that.
We got another question. Just kind of like generally speaking, would you advise, or do you think it's safe to hire an accountant to handle the financial model in order for the founder to focus on the business building?
Yep. So it's a great question. I'll say accountants typically, it depends on the person, 100%. Some accountants maybe have good forecasting experience. Generally, there's kind of like a bifurcation in finance between past and future. So you can think of past as accountants, controllers, things like that. Future is more CFO, right? Or financial analyst and things like that. So typically accountants aren't, overgeneralizing here. Typically accountants aren't the people that you want to build your financial model. I'll say whenever it comes to completely passing off the financial model, as the founder, you don't necessarily have to be the author of the financial model. You don't have to write every line, every formula if you're using Excel, and you don't have to build every inch of it as the founder, but you do need to understand it. You do need to have a working understanding of what the model is saying and the logic that goes into it. Because at the end of the day, it's like, it's important for you to understand it so that you know where the levers are, back to that exercise we just did. You can use it to make your business better. But B, because you're going to have to walk through it with an investor, and they're going to, if you don't understand it, it's going to come out, in that meeting. So I would say you don't have to build it on your own. But if you get somebody else to do it, then make sure that you understand it. And your accountant is probably not the best person to do it. Almost certainly, I would say. But if it's a really good accountant that's got some experience in that, then maybe. So
yeah. Just to add on to that, typically accountants are like expertise in bookkeeping is not the same as expertise in financial modeling, and you need someone who's like well versed in like being like a cash strategist, because they will know how to your point, look to the future, not just reconcile your past costs and revenue.
Yeah. There's a reason that like a CFO, like if you look at like the value of like, if you were to hire a CFO, full-time CFO, you're going to be spending hundreds of thousands of dollars versus an accountant, which is, a small fraction of that price point. There's a reason, for that. One's more strategic. So
yeah. We've got a question from Ron Pedzensky. He says, how do you handle variable subscription prices in your model, i.e. usage-based pricing?
Yep, it's a great question. So there's some assumptions that are going to go into that. And like the way that we do it is we just kind of like augment our revenue formula. And it kind of depends on the business. So we can talk deeper if you want to chat about your business specifically. But generally, what we like to do is we like to like include within our revenue formula if it's $3 per month per transaction, let's say, I don't know, I'm making something up, then I'll have a line in there for average number of transactions, right? And over time, do I think that the blended average is going to go up? Do I think it's going to go down? Or do I think it's going to stay relatively flat? So then I can go in and kind of forecast, like, not only are we going to grow our subscriber base, but we're also going to increase their usage of my software. So the average number of transactions is going to go up too. So you're kind of getting like a lift on both fronts from that standpoint. So it's just another line kind of in your revenue formula is the way that we like to think about it, or another multiple lines depending on the business.
And I think a lot of it starts, whether it's, usage-based pricing, whether it's figuring out conversion rates, a lot of it starts with like accurately tracking what it is that you're doing.
Yeah.
To use like a different example, like, I've come across people before who are like, oh, we're going to write a series of LinkedIn articles and that will drive X number of customers. But then they never go and see, did those LinkedIn, like they never actually say, and you could literally just like create a note in your notes app or do it in a Google sheet real quick, like post and what are the dates? Well, how many leads did they drive underneath that? And the number of people who don't actually think to look back and see, did this thing that I created actually return what I thought it would? And then you keep operating off of these false assumptions. It just makes you make the next decision even more poorly than the previous decision.
Big time. Yeah. Tracking's a massive piece of this.
Let's go to Shubha Chakravarti asked, will you be talking about? So I'll phrase it a little bit differently. How about how should a founder watch for phantom assumptions, like changing one lever without understanding what other levels would also move? For example, an increase in marketing costs to drive an increase in sales.
Yeah, it's a good question. And that's where it becomes kind of like more of an art than a science in some, like there's like a little bit of theory behind it. So like one example, like in the example that I just gave, right? We talked about how price would increase and then I think churn rate would increase as well, right? But we didn't loop in conversion rates, right? So now if I'm trying to sell a higher dollar thing, my conversion rates are probably going to go down as well. So by how much, I don't know, right? But the way that I like to think about it is, you want to run the experiment, or like you want to put in, like if I want to double price, let's say, and then you get your parameters for, I know how much this can fall by for me to know whether or not this is something I should do going forward. So like, let's say I increase my price and I see that my churn rate goes up by 10% and my conversion rate falls by 10%. Plug those new numbers into your financial model. Now that you know what your new conversion rate is at this price, plug those into your financial model. Am I better off or am I worse off with these new numbers? If I'm better off, do it. Keep it going. You know what I mean? Like now you've just found a way to make your business better. If you're worse off, that's fine. Revert back, as a failed experiment. But what you don't want to do is not have any sight into the future and just like, you're basically like throwing stuff against a wall at that point. If you're just like, I'm going to increase my price and like, I don't know, like maybe I'm better, maybe I'm worse, I don't know. That's what you want to avoid. And that's what a financial model will help you do.
Mm-hmm. All right, Logan, we are at time. This was fantastic. So thank you to everyone for joining today. Thank you to Logan and Calvin for running this show today. This was Financial Modeling 101. This was the first of 3 Forecastr Fridays. So we'll be back next Friday, same time, same digital place. And that's where Forecastr number 2, I believe, is how to use your financial model to raise capital. So we'll come back with that one. Please join us next week. Again, remember, you got to sign up for that one as well if you have not already. We will get you the recording and the slides from today as well, but just everybody, please, it's Friday afternoon and Monday's a holiday. Just please be graceful. It'll get to you like middle of next week. Please don't hound me on the weekend being like, where's my recording? We will get it to you. Don't worry. Just give us a couple days here.
Yeah. Thanks so much. It's a ton of fun. Looking forward to being back on Friday. Appreciate it.
Appreciate y'all. Thanks. Have a good weekend, everyone.